We are officially live, broadcasting only on onedealaway.com/live. This is Money Matters. My name is Nev, and today's episode we have all kinds of juicy and important news. One of the most important things to talk about is sort of where we are financially speaking, globally financially speaking, right? As a country, as a planet, when it comes to money, and I think it's important to talk about it. Look, there's many things that have been doing pretty okay because we have been held by sticks and duct tape and federal stimulus and that kind of stuff. But a lot of those things have expired, and we are now hitting a month worth of lack of additional payment, no stimulus in sight, right? And they won't even start conversations until next week. And then who knows how long it's going to take them to come up with something. We're seeing riots all over the place. I mean, things are definitely starting to look beyond scary personally. And one of the reasons that we're doing this show is to, try to avoid the scary piece. But of course, we don't control what happens with any of that stuff. I don't have any control over it. You don't have any control over it. So the best that we can do is, right, control ourselves, do the best that we can to control our own money, our own destiny, and doing that by learning what's going on, what might be coming our way, and putting ourselves in position where we could do well or well enough or extremely well, depending how well we read things and how soon we put ourselves in the position. So today we have some very, very interesting articles that talk very specifically about what's going on with zombie companies. You've likely heard of the term. We're going to dive deeply into what that actually means, and we're going to talk about the bond market. It is one of the largest markets. Of course, the derivatives are the largest, but aside from derivatives, bond market is actually way, way larger than the equities market. And so we're going to be talking about what is happening inside the bond market, and could it potentially signal to us what is going to happen in the near future. We're also going to be discussing what's happening with the consumer consumption, right? The consumerism, and where we are with that stuff, what has been holding us. We've been talking a little bit about it, but now we have some charts and different perspective. It's similar perspective, but just from a different person. So it's not just me, right? It's other people talking about it. And we're going to be talking about what this whole pandemic thing has done to our savings accounts and whom it has been affected the most. So if you want to figure out what's going on, where we're heading, and how to position yourself, today's episode might do just that. Let's do this. All right. Good morning. Good morning. Hopefully, you heard that. I was playing around with the audio stuff. And it's always a bad idea when Nev plays around right before we go live. But sometimes I just forget that it's a bad idea. Talk about human conditioning, where sometimes we forget the bad stuff and just go with what we want to do anyways. And then when it's too late, right, while it's playing, we end up realizing that this is bad. And it kind of plays along with what we are seeing on basically the global financial concept of what's going on. So, what is really going on? Well, if you look at the stock markets, you are thinking the world is all good. I mean, people are making money hand over fist. There's trillions of dollars out there sloshing around. But then you look at your own life and turn around your own streets of wherever you live and realize none of those trillions have reached any one of us. Well, where the heck did that money go? Well, that is what we're going to discuss today. And we're going to start with the first article that I have found for you. And it's coming to us basically saying millions of Americans had their emergency savings wiped out by the downturn. and we're going to be discussing whom exactly has been affected by it. But before we go over there, I do want to mention one thing. Now, some of you might have heard this, some of you might have seen this. So, right, but quite a few years back, I want to say maybe 2018, maybe 2017. I could be lying here, so please do fact check me, as I like to say. But the Atlantic, right, the magazine, had done the article, and it was on the front page. And I remember it was a guy. I think it was a guy. It looked like a guy on a picture, right? And it had the paper bag over their head with like a sad face, just kind of standing and pulling out like empty pockets, right? And it said that on average, the Americans have less than $400 in savings. So we went into this whole beer overflow, as I like to call it, because I'm still trying to figure out, does it do anything with algorithms or not, and I don't know quite yet. So I'm going to keep on doing it for a little while longer just to see. And if it doesn't do anything, I'm like, forget it. We're going to be saying the name of the beer, right? And everybody knows what beer I'm talking about, right? It's the Mexican one, right? And it's not SOL. I no, seriously, that is the name of the beer. So Mexicans have a very, at least the beer making companies have some very very funny names. You're either SOL or the pandemic version. So which one would you like? Maybe both. Maybe both. Anyways, before we go into this stuff, I do want to welcome everybody watching this live on onedealaway.com. Please sign in. Feel free to chat, say hello, and we're going to be doing a Q&A at the end of the show as always. And if you're watching this on YouTube or somewhere else, do me a huge favor, smash that like button, do subscribe, hit the bell button, and I will see you tomorrow. Now, I'm not ending it right now. Don't go anywhere. Just smash the like button right now, and then we're going to do the rest of it. Okay, so we went into this whole thing without a whole lot of money anyways. And now, here is what we're seeing. Recession wiped out 14%, or about 46 million Americans' emergency savings. And this is a survey that was conducted. They're over here basically, saying, hey, tapped into my emergency saving, wiped out my emergency saving, borrowed money. So it's this entire thing. Let me see if we can see it. Yeah, we can. Now I probably lost what I had highlighted, so we're going to have to learn from it. But let's take a look at what basically folks are saying. They're saying, I tapped into my emergency savings, wiped out my emergency savings, borrowed money to cover everyday expenses, stopped contributing to my 401k or other retirement accounts, asked for rent relief or delay, moved in with family member, taken early withdrawal from my 401k, borrowed from my 401k, applied for mortgage forbearance, moved to a smaller home, none of the above, and no answer. So about 59% of overall folks said none of the above, but 17% tapped into the emergency savings, 14% wiped it out, 11 had to borrow money, 6% stopped contributing, 5% asked for rent relief or delay, 4% moved in with a family member, 4% also taken early withdrawal from 401k, 3% borrowed from 401k, 2% applied for mortgage forbearance, 2% moved into a smaller home, 2% didn't give an answer. So, and it's kind of nice because it gives you a bit of a ethnicity of what's going on. And as you can see that, overall, it's equal distribution plus minus. We are seeing that based off of the survey, that on the race ethnicity, you have white, black, and other, right? So apparently there's only two combinations that you can have, or other. You don't belong into either one. It's kind of like, anyways. So you can see that the black population has been affected a bit more harshly, right? With white, you have, 65 that didn't, that none of the above applied to, but only 48 when it comes to black, and about 56 for other. So it seems like they are hit very, very strongly. Now, we do have also Hispanic, and they seem to be hit just as harshly as the black population. So There's right, and of course, oh no, it came back. All right, excellent. So about 17% had to tap into emergency savings to cover living expenses. 11 had to borrow money, right? And so we talked about this stuff. We just looked at it. The percent of correspondents who wiped out of the savings due to the onset by age. Let's take a look at this particular chart right over here, and you can see that we had about 10% didn't give us any answers whatsoever. 9% are 18 to 24. 26% are 25 to 34, and 21 are 35 to 44. If we add 21 and 26%, we come up with a whopping 47% age 25 to 44, and this is predominantly millennial generation. So they have been hit the hardest. Now, of course, folks that are 65 and up are the boomer generation, and they have been hit the least. Now, it makes kind of some sense, and we're gonna discuss it right over here. All right, where did my highlights go? Okay, no, it took it down. It disappeared. All right, it kept some, it took out some, but basically they're basically saying that the 6% of the boomers drained their savings, but they've been through multiple booms and bust cycles, and they tend to understand the importance of saving for a rainy day, unlike millennials who have only been through one recession, and many of them were too young to remember, right? They were either in high school or maybe college. So while recession was kind of happening, you weren't as aware of the whole situation because you didn't live through it, right? Like as an adult, we experience things a little bit differently as kids than we do as adults. And so many of them didn't experience it, so many of them didn't save. Now, I am also going to add something that is not part of the article at all that might explain this difference of only 6% of boomers versus 47% of millennials. And my explanation is this, that many of the boomers have had all these years to make quite a bit of money and save a whole lot more, right? Their 401ks are much larger because they've been accumulating it for a very long period of time. They've also had very good years, especially in the 80s and the 90s, that they had an opportunity to make quite a bit of money, whether through investing, whether through whatever sources that they were doing, right? So I made it so much simpler for them to do that. On top of that, they didn't have this leverage, also known, or, burden, I guess, leverage, burden, whatever you want to call it, but I would call it burden of student loan debt, whereas vast majority of millennials actually have that. So for millennials, not only is it tougher because all of the asset prices are much higher, their income, comparatively speaking, is much lower, but they also have this added student loan debt that they're saddled with and can't eliminate and get rid of. And I believe that the combination of those things explains why we're having this such a large amount of people, younger people, that basically have zero money left, and this older generation that, very few, right, percentage wise speaking, have depleted their savings accounts because A, there's a larger and the expenses are likely less. Now, right, we could argue that they might potentially have higher medical bills and that kind of stuff, right? So we can get into some of those pieces. But I think the piece where they were talking about is that they are, really talking about what's going on with the unprecedented economic damage. While more than 30 million Americans are collecting unemployment benefits, the labor market recovery has stalled as the Fed's new policy to raise the inflation target above 2% will result in a higher cost of living for tens of millions broke, jobless Americans. What's even more stunning is that a quarter of all personal income is derived from the government. And I think we all need to remember that component and the fact that much of that stuff has stopped. And of course, we do have additional information that we're going to be going over very shortly, additional article that kind of digs a little bit deeper into this story. So you can see the government transfer payments as a percentage of total income. And you can see the sharp rise. Now we saw a sharp rise in kind of the fall, but then they zoom in, and it doesn't look as big of a fall, right? When you kind of zoom out, because this comes out of 1959, and you can see it's kind of mostly flat when you go in, and then it just giant spike and sort of slight leveling off, but it's still pretty high. Now they're talking about the fact that there's going to be this K-shaped nature of the recovery, where the political elites and ultra wealthy are bailed out by the Fed, while millions of individuals who have completely run out of savings, depleted stimulus funds, and some can no longer afford food as the fiscal cliff hits. So we are here. And here is the interesting chart, right? Where they're saying, well, we had a lockdown. Then we got the central bank of fiscal stimulus, right? Then we kind of got here where the reimagining versus reopening, right? And then what happened? Well, technology, large cap, wealth, and white collar kind of went on up. Cyclical small business, poor and blue collar jobs kind of just went down and disappeared. And they're saying there's going to be a convergence that we're already starting to see. Now, what's happening with Congress and the Fed? Well, not much. And they're saying, well, stress and low income household enough, and they will eventually assemble and revolt. And that is what we are seeing right now. It might have sparked it by one thing, but now we're seeing it sparked in many other ways. Now, there's another article that is also talking about the devastation of the consumer fiscal cliff. So, the topic for today is fiscal cliff is here, right? And it's not going away anytime soon. So the consumers have continued to spend in July, but it won't last. And you can see that the real spending versus income month over month, that we kind of have the real DPI, real PCE. We'll cover it. We'll cover it. And so what is going on, right? So here is the COVID, the stimulus, right? That led to spending and rebound, and then it kind of, starting to taper off. Now, real spending versus real income. And you have the real disposable income is this red line. So DPI, right, is the disposable income. And the PCE is what they're calling is the personal consumption expenditures, PCE, right? So that's the blue one. And you can see personal expenditures kind of go down, then they sort of picked up, and we see sort of what's going on, that there's this sort of this divergence of things. Now, what they're saying is that personal income personal income increased, this is July 2020. Personal income increased 70.5 billion or 0.4% in July, right? Remember that. Disposable personal income, DPI, increased $39.9 billion, which is 0.2%, so half of the personal income that increased. But personal consumption expenditures, PCE, increased $267.6 billion, which is 1.9%, right? So it's like way out there comparatively speaking, right? So income is kind of up. Personal disposable income, right, what you can dispose of, went somewhat up, but the consumption expenditure went way up. Now, real DPI increased 0.1% in July, while the real PCE, the expenditure, increased 1.6%. Now, this obviously paints an ominous picture because, as we know, that the sort of that additional stimulus, that $600 a week, had expired on July 26th, right? So that's an important thing for all of us to remember and recall. As of August 28th, consumers will have missed 5 weekly checks of $600 each, and that's a lot of money if you add it up. Over 27 million people have missed the 5 weekly checks of $600 each, and they kind of take a look at the continual claims. I'm going to take some water while you take a look at the chart. Okay, now when you do the math, that's $81 billion that is no longer entering the economy. And that's the money consumers don't have to pay the rent, pay mortgages, buy food, or do anything else, right? So the consumering stops, right? Or if not stops, it slows down. But for these folks, it definitely stops big time, right? Continued claims are covered employees who work no hours. That's at least 14.5 million, but that does not include the gig workers, self employed, and others who are not covered. And that number is, relatively speaking, large. So you can see another one over here of what's going on. And my best guess, the author's best guess, is around 20 million people that are solely reliable on the assistance from the government. Of them, about 6 million people have no money coming in at all. 14.5 million have only state benefits, and that's not nearly enough to pay for the bills. Now, what's going on with the congressional stuff? Well, there is congressional bickering and no end in sight. They're going back and forth, fighting. Meanwhile, folks who are depending on this to be able to make the ends meet in some sort of level, they are not getting much of anything. A financial cliff is not coming up, but it has already started. It will show up in August data, accompanied by a jump in evictions and repossessions. When we talk about repossessions, right? What ends up happening if you can't pay for a car? Well, they just show up randomly one day. There's a tow truck, they load it on it, and they drive off. We saw that in 2008 financial crisis, and we're going to see that yet again in this particular crisis. Now, this is kind of what's going on when it comes to individuals, and that kind of stuff of the dark side of the persons and individuals. But we also have a very dark side when it comes to companies, and those are very much connected. And on the business side, we are seeing zombie companies that have already existed, but the numbers are going higher. And here is a report that basically says through the first half of August, which is normally a quiet period for the bond market in the US, a total of 56 billion in junk bonds and leveraged loans were issued by junk rated companies, nearly 50% higher than the prior records. Fed's announcement on March 23rd that it would start buying corporate bonds and bond ETFs set off a huge rally in the bond market. Rally started before the Fed ever actually bought the first bond, but the announcement was enough to trigger the biggest junk debt chase in the shortest amount of time the world has ever likely seen. And if you've been paying attention, you will recall that that was really what happened. They make an announcement, everybody gets excited, Fed didn't do anything for months, and then they kind of started doing the stuff, right? So they used the announcement to goose up the market, to goose up people to actually jump in. Then they started buying after that. The junk bond ETFs and the Fed dabbled in hold junk bonds issued by companies that have been taken over by private equity firms in leveraged buyouts. Oh my gosh, it's coming up again. We just been talking about this particular thing, right? With SPACs. We talked about it yesterday. So watch the yesterday's episode if you haven't seen it to understand a bit more. And we've talked about the private equity and how dangerous that is. We talked about it in the 401k changes video, right? Where they're coming for your money that way as well. And what they're doing is basically they use the money, they do the leverage, and then they leave the empty shells of the companies with the equity holders holding empty baggies of nothing. Where the acquired company itself borrows the money to pay for its own acquisition. Leverage buyers produced the first big wave of bankruptcies among retailers that started years before 2020. It included Toys R Us, which is now liquidated, but it's not the only one. It's just the most recent large sort of liquidation piece that we know about. Nordstrom is another one. I think J.C. Penney's is another one. We are seeing some of the other ones that are coming our way as well, which is why I keep saying, if you want to play the market, go for it. Have fun, but be very, very smart and very strategic about that stuff. That's the reason why I'm also very scared when people are piling into Hertz, when Hertz filed for bankruptcy and everybody went bananas. And I'm going, my gosh, I mean, you are about to get hurt, right? Hertz? Get it? Get it? Yeah, the jokes are, this is as good as they get, y'all. This is as good as they get. In the second quarter, companies that had been taken over by private equity firms issued over $31 billion in junk bonds, the highest level since 2014. Now, Carnival, yeah, here we go. We're going to name names, dropping names. Carnival, which is the largest cruise ship operator and also deeply in debt, super big on junk, issued a sold its third bond issue since the March beer overflow started of $900 million in junk bonds with a yield of nearly 10%. Now, how in the world is a broke company going to pay that kind of money? Well, they will just borrow more. And then, but they're not getting any income, right? Nothing is happening because people are not really, right? We're not cruising around quite yet. And every time you hear of a cruise going out, the ship basically has to quarantine because everybody on it is sick. Royal Caribbean, which is the second largest cruise ship operator, issued $3.3 billion in junk bonds in May. The collateral, well, it's the cruise ships, among other things. But the problem is that the cruise ships, well, they're not very, very useful right now. I mean, you can't cruise, right? So now you just have a giant liability that presents itself like an asset, but it's really not because it's bleeding you dry because it's a huge expense. I mean, you got to maintain these things, clean these things, store them. Hello, have you looked at how expensive it is to park your boat somewhere? Now imagine having something super ginormous, right? So it's very, very expensive to do that stuff. This borrowed cash will be gone and the debt will remain. What will they do? Well, they're going to restructure. How do they restructure? There's two different ways. One is the bankruptcy, right? It's kind of like what Hertz did, right? Which is what J.C. Penney's is doing, Nordstrom is doing, you name it, they're doing it. California Pizza Kitchen, Dunkin' Donuts. I mean, right? Like just about any name, Lucky Jeans. You name the name, they're likely going through it, right? Or they're going to do it outside of the bankruptcy court by transferring all or much of the equity to the creditors, with shareholders getting wiped out. Ouch. For investors, a restructuring would be very, very ugly. However, for the cruise line, it would be a great thing because what happens in restructuring? Well, they go through the whole thing, they forgive and forget a lot of the loans, eliminates the stuff, those that are holding the bags, which are the investors, which is why they are actually getting hurt. They end up losing the money because they're not getting paid. They're not getting much of anything. Those equities basically become worthless. The new stuff gets issued out, gets reissued, and the company ends up being smaller, leaner, meaner, ready to take on more debt. Yeah. The Fed made it possible for corporate zombies to raise new money from investors and become even bigger zombies. Bank of International Settlement, which is the federal bank for the federal banks, uses the term zombies, and it defines the term companies that are unable to cover debt servicing costs from current profits over an extended period of time, meaning the company needs to constantly raise new money from creditors to pay existing creditors. Now, outside of the corporate world, we call this a scam. Right, exactly. I mean, what do you call something, right, where the only way to make money is by new kind of money coming in, right? So the only way to make some sort of profit, it's kind of like the MLM pyramid scheme, right? And I'm not saying that all exactly the same, but the pyramid scheme, right? Like I come in, I recruit two people, they kind of buy in, that's how I make my money. And then those two people require two people more each. That's how I make my money, right? So that's kind of how this whole thing works. And like that's a scam thing, but we call them zombies when it comes to business these days. In the late 1980s, less than 3% of the companies listed on the US exchange were zombies, according to BIS, right? Bank of International Settlement. By 2018, 19% were zombies. And I think that now we can say that this number is way, way, way higher than it is right now. Now, what is the forecast for all of this stuff? Well, here it is, y'all. S&P Global and Moody's are forecasting that the default rate for junk-rated U.S. companies will exceed 12% in early 2021, but the market doesn't care. The market thinks these companies will never default. Now, we'll see. Will they stop them? I don't know, but we do have to remember one key thing, that something works until it doesn't. And when it doesn't, it gets very, very ugly, very, very fast. And it starts really slow, and you don't notice it. And the next thing you know is boom, the cliff is there, and you are moving way too fast to avoid it. Sorry about that. Mm. I can talk for hours, but sometimes you just need to liquidate. Liquidate. Get it? Get it? Yeah, I told you, jokes are not going to get any better. So now I want to follow up with this article over here of what's happening with the whole lending and the bond market, right? So we looked at that stuff. We looked at what's going on with the zombie companies. We looked at how the population in general is being affected and kind of where we are. So it's not looking very, very pretty. Not at all. Not even in the slightest, right? Lending is now the sucker's game. Devalue or deflate everything owned by the little people, buy it up for pennies on the dollar with unlimited free money. This is the program, and attempt to use the massive financial asymmetry between the super wealthy and the ordinary to manipulate markets back upward through artificially goosed demand backed by empty, cheap money purchasing power. Now, what basically means is that right now lending is super, super cheap, right? And if you're a company, a corporation super big enough, well, you can get your money for zero, right? Zero interest rate. And then you can use that to, right, buy your equities, use that to then issue some bonds, use that to, continue. And so it's just leverage upon leverage upon leverage. And you go in and you buy assets that actually start going up in value. And that is what this article is talking about here. Now, what you can look forward is a canary in the coal mine indicator of when things will go south in the equities market. My bet, junk bonds. Junk bond market are special kind of crazy right now, but to follow an oddly transparency logic of manipulation when you look at them closely. On April 9th, 2020, for the first time in its 107-year history, the Fed changed its terms and bought junk bonds, bailing out the trashiest level yet, the deceits of the big players, particularly private equity firms. OMG, coming back again. And here is what the chart looks like, y'all. So, of course, you will see that this is the market, right? And this was in March, and we kind of did the crash. And then the Fed announced on March 23rd that they're going to be buying stuff. They actually go in. They actually go in and start buying right here on April 9th. So they didn't buy for a while, but the market started going bananas crazy, and then they bought it right there. If the lowest of the low are being rescued, then it's a sure bet that any company with sizable footprint in the market will be rescued. The small companies want mom and pop shops, right? Mom and pop shops won't actually be rescued, right? You got that PPPPP, that, right, you can't pay back. And there's no, like, guarantees or rulings or any of that stuff, so you're like trying to figure out how to do that stuff. You are told like you can reopen, but then you can't reopen fully. Then they kind of close you back down. Then if you're a restaurant, you can only do 25%, maybe 50%. Try to do this, try to do that. Next thing you know, you are forced to close. And closing day are left, right, up, down, front, back, all around us. They are closing. And I will tell you, I just got heard new bad news or sad news yesterday. I want to say yesterday evening, my favorite restaurant of them all, the only place in entire states that Nev can actually go and eat, because I have very specific food regimens and things that I do or don't eat and can and cannot eat and refuse to eat and so on. So this was the only restaurant that catered to people like me that kind of have very specific things of what we can eat. Unfortunately, after 9 years of being in a business, had to shut down, and that was super super sad to hear it. But they're not the only ones. We're seeing that everywhere, and they are not getting bailed out. So you have to be large enough for them to step in and bail you. There's an exponential rise in the Fed's free backstop money printing program for zombie companies like Carnival Cruises. So, Carnival Cruises, we just read about it, but they are companies that have been taken over by private equity, right? And they are Carnival, the largest ship operator with a deep junk credit rating of triple C, whose revenue collapsed to near nothing. In early August, sold its third bond, 900 million in junk bonds, yielding 10%. Is this sustainable? Of course not. However, it is a short-term reality of what we're seeing. There has been sustainable talk of the Fed backstopping the stock market by buying up stocks directly if needed, because now the financial markets are entangled in the equities market. Lending is now the sucker's game. You get paid back in inflated poor man's dollars on an asset that has skyrocketed, the worst of both worlds, whereas borrowing has the best of both worlds, cheap or free money for endlessly invest in limited assets, and that doing that by investing pushes the prices even higher, right? So I'm going to read this again, sort of try to explain this again. So lending right now, sucker's game, right? Now, most of us are thinking, well, I'm not a lender, but some people are lenders right now, and it's not the time to do that right now. It will come time in the relatively near future of how to become a lender if you have substantial cash and you want to actually generate some money on the money, but right now is not the time. Borrowing has the best of both worlds. You get the cheap or free money, right? If you're a large company, you get free money. If you're not, you can now get very, very cheap money, super low interest rates and that kind of stuff, right? And then you can go in and buy assets which are limited. Then you have to do your due diligence and do the research and that kind of stuff. But you can buy it, but because there's this money that is being created and people are jumping in and moving it into it, it's going into assets, which means that those limited assets are going up in prices. This creates a cycle of concentration that keeps exchanging things of counterfeit value, derivatives, borrow money, and that kind of stuff, for things of real value, which is hard assets, businesses, and so on. This is what private equity firms do. This is what banks do. Well, they also lend money, but we don't want to do that piece, right? And then inflate the value of the real thing by artificially manipulating the money supply, this whole printing piece. This is the reason why people like Robert Kiyosaki, for example, if you follow him, talks about the savers are losers, because your money is getting devalued. It's becoming worthless because there's more and more and more of it coming in. And so what you need to do is figure out, how do I take this money, get into the real assets with this money, potentially leverage. Be very careful with the leverage, please. You don't want to overdo it. You don't want to go bananas crazy. And you always want to do it for something that is poised and has a potential that provides you with income, with cash flow, and also could potentially go up in value, right? True, real assets, right? That's what you want to do. Again, not a financial advice. Nothing that I share in this show should ever be taken as financial advice, ever. You gotta do your own research. You gotta do your own education. You gotta do your own stuff. And if you need financial advice, then you get a financial advisor. All right? This has been done for decades by private equity firms, leverage buyouts, corporate raiders. They profit handsomely by hollowing out the economy and creating stress and debt, which they make advantage by breaking up these companies or allowing them to go bankrupt. And we've seen that. Now, we don't want to do that. We don't want to bankrupt anybody. We don't want to hurt anybody when we consider following some of these footsteps of what they're doing. But we want to understand the game. And the game is you take cheap money, right? You buy real assets, right? And then you take the money from that real asset and the appreciation and the cash flow and that kind of stuff and apply it to yourself so that you can eliminate this debt potentially or roll it over if you can, right? So that is sort of what the game is. It's moving the money constantly. Now, private equities, they do something else a little bit weird. They take a company, they chop it up, they sell the parts, which they make the money, or they just take out the value from it and then leave the empty shell like we talked about. And then, those that are holding equities basically end up losing on it. So this is what I wanted to share with you. And so now my question to you is, how valuable is financial education to you? You gotta be smart when it comes to money. You gotta watch what the big guys are doing and try to follow in the footsteps of what they're doing. I'm not saying do everything. Some of the stuff is, really shady. Some of the stuff we definitely don't want to do because it's kind of, unethical. I don't believe in doing that stuff. But there's definitely some bigger picture things to think through and then start learning how do I apply what they do in my own life to benefit from what's going on and where we're going. So I hope this is helpful to you. Please do hit that like button if you have enjoyed it. Do subscribe, do hit the bell button, and I will see you tomorrow. Thank you for watching. Those watching live, we're about to go into a Q&A. Those watching on YouTube or elsewhere, until next time, stay forever money blessed, and do remember, you are only one deal away.